Welcome to Property Strategy with your host, Rad Serene. And on this channel, we talk about property strategy, finance strategy, and wealth creation in a simple and concise, easy, and practical way that you can implement every day. There has been a massive shakeup to property investing as of the 27th of November 2025 that is likely to categorically change investment strategies, how we invest in real estate, the strategies that we've used in the past. And in this video, I'm going to take you through what that is and how it impacts you. So if you're a property investor with skin in the game, thinking of expanding on your property portfolio into 2026, definitely stick around and hit that subscribe button. By way of background, for those that don't know me, my name's Rad Serene, and I've spent the last 15 years investing in real estate and close to 20 years lending money to individuals to grow their wealth through real estate. I've also created in this time my own 8-figure property portfolio. And I also run a national property investment buyers agency, having purchased hundreds of properties all across Australia. So let's start at the basics. What's Apra? What do they do? Apra are the Australian Prudential Regulatory Authority, and their job, their number one job, is to govern banks. It's to give them rules and guidelines to follow so that banks don't stray, so that the Australian banking system remains strong. So, what have Apra done and why does it impact us? So, Apra has just announced that banks will be barred from lending more than 20% of new loans with a DTI or a debt to income ratio of 6 or more, as the regulator is clamping down on risky lending. Investor lending now, as of November 2025, is 60% higher than owner occupier lending. We've had multiple interest rate cuts since February, and this has resulted in larger borrowing capacities and a flurry of investors rushing the market to get in with a lot of fear of missing out, creating property price growth that is frankly unsustainable, and the government is aware of this. It all starts with lending. So what's the quickest way, other than interest rates, to stop people borrowing money? Well, it's this. We've now got banks coming out with 40-year loan terms, as you'll see if you follow some of my other videos. I've done a whole video on this. Not only 40-year loan terms, but they're also allowing interest only for investors on 40-year loan terms. There are also lenders that will waive lenders' mortgage insurance up to 90% for investors. This just allows more people to enter the market and increases borrowing capacities by $50,000 to $100,000, because that's an extra 10% that you don't need to come up with. You don't need to come up with a deposit, neither do you need to come up with a lender's mortgage insurance, and you can buy that same asset with a greater borrowing capacity, sometimes at far reduced interest rates than you would normally expect over the last 3 or 4 years. Now, this rule applies to ADIs and comes in from the 1st of February 2026. And it says again that lenders aren't allowed to lend more than 20% of their lending book to investors that have a DTI or debt to income ratio above 6 times. So simple maths on that is, if you have an income of $100,000, all you're allowed to borrow is $600,000. And the banks, if the banks do lend you, say, $700,000, then you would be classified as one of that 20% that the bank's allowed to lend to. Once they reach that cap, that's it. If you recall, they did this in around 2017, 2018 to slow the Sydney property market boom, and it had exactly that impact. Now, there is some positive news. The positive news is that ADIs, accredited deposit-taking institutions or banks, most of them aren't at their 20% mark yet. In fact, looking at some data recently, I'd estimate between 10 and 12% is where their books are. So we still have a little bit of fat. However, this is a clear shot across the bow for investors, for us to stop, think, pull our heads in, and consider the ramifications of what APRA considers risky lending, high LVR, high debt to income ratio loans. They really just want to put a stop on that. And it's basically to stop speculation in the market, which APRA feel that investors are now speculating as to what the property market might do in the future. So guess who your best friend is in an environment when credit policy is tightening and will continue to tighten? Get really, really, really close to your mortgage broker and tell them how much you appreciate them, especially the good ones, because these are the people that will get you through the next cycle, the next phase, the next lot of strategies. We've just seen Macquarie pull out of trust lending. We've just seen CBA tighten trust lending. I think there'll be more here, so watch this space. And now we have Apra impose a 20% buffer on investment loans. So I encourage you over the Christmas break, do what's right for you. Spend time with your friends, with your family, but please take some time to sit down and understand what is your strategy. How are you going to retire in 5, 10, 15, 20, or 30 years? Are you still relying on the government pension? Or have you got plans and strategies in place that will get you out of the rat race? Hope this video has been insightful for you and stimulate some thought processes in your mind over the Christmas break. Happy investing.